Welcome back, and I look forward to introducing you to the third session on challenges and opportunities for the financial services industry in the aftermath of the coronavirus pandemic. First, we are fortunate to have a recording of Ms. Sonia Gibbs of the Institute for International Finance. Ms. Gibbs is currently Managing Director at the Institute of International Finance and was previously head of East European Economics and Chief Equity Strategist at Nomura International. From our end in Seoul, we are pleased to have Professor Kim Jung-sik serve as moderator for this session. Professor Kim is currently president of the Korean Social Science Research Council and previously served as president of the Korean Economic Association, Financial Supervisory Advisory Committee chairman of the Financial Supervisory Service, and chairman of the Financial Services Commission's Financial Development Council. Please join me in welcoming Professor Kim Jung-sik.
Thank you, Professor John. Good afternoon, ladies and gentlemen. Welcome to the Session 3. Our topic is the challenges and opportunities for the financial service industry in the aftermath of COVID-19. Actually, Mrs. Sonja Gibbs of IIF is the moderator of this session. However, she is unable to come to Seoul due to the COVID-19. So I will moderate these sessions. First, Mrs. Sonja Gibbs will address introductory speech on video.
Ladies and gentlemen, distinguished guests, on behalf of the Institute of International Finance, or IIF, here in Washington, D.C., and our members around the world, let me say that it's an honor to be asked to provide these welcome remarks for your conference, The Economic Paradigm Shifts in the Post-COVID-19 Era and the Future of Finance. We are very grateful to the Institute for Global Economics and Hana Bank for arranging this important international event, and we appreciate the opportunity to share our thoughts with you. We are sorry not to be there in person, but we'll do our best to provide these remarks from an international perspective to help complement the wonderful array of speakers that you've brought together on this occasion. The topic of paradigm shifts is, of course, tremendously timely. There are shifts in the economic paradigm all around us in all directions, and the financial sector, as a key intermediary in financial flows around the world, has been particularly affected. So for this session on challenges and opportunities for the financial sector in the aftermath of the coronavirus pandemic, we have a fantastic lineup of speakers. Following the order of the program, you will first hear keynote remarks from IIF President and CEO Tim Adams, and then some fantastic keynote addresses from Anne Kruger, who is Senior Research Professor of International Economics at the Johns Hopkins University School of Advanced International Studies, and she is also Senior Fellow at the Center for International Development at Stanford University. And Anne, of course, also served as first Deputy Managing Director of the IMF. We will also hear from Michael Taylor, who is Chief Credit Officer at Moody's Investors Service and a highly respected voice in the context of developments in credit ratings and debt markets. I'm also pleased to introduce to you, and you will all be familiar with these gentlemen, Kim Jung-sik, who is Professor Emeritus of Yonsei University and also President of the Korea Social Science Research Council, and Shin Sung-hwan, who is Professor at Hongik University and President of the Korea Money and Finance Association. I'm very pleased as well to introduce Kim Hyung-kon, who is a partner with the Boston Consulting Group. So let me now offer a few remarks on sustainable finance and environmental, social, and governance, or ESG issues for the financial sector. The first point I'd like to make is that momentum on sustainable finance is continuing despite the COVID-19 pandemic. COVID in many ways has been something of a catalyst for sustainable finance, and it truly highlights the need for change, including on social issues. So you might say the S of ESG has become more important. Many people are now talking about a post-COVID landscape, but when it comes to sustainable finance, this pandemic has served to bring a whole range of social and governance issues front and center alongside climate goals, which are, of course, no less important now than they were prior to COVID. Many of these social and governance issues, for example, woefully inadequate healthcare systems, or how well governments can channel fiscal support for pandemic response, these are at the heart of the Sustainable Development Goals, or SDGs. And although this lockdown on COVID has certainly cut carbon emissions, for example, the International Energy Association, or IEI, estimates that carbon emissions will fall by 8% this year, the fact remains that carbon concentrations are still rising in the atmosphere, even if it's at a slower rate. And history shows us clearly that global economic recoveries tend to be highly carbon dependent. So the risk is that the rebound in carbon emissions will be sharp as countries around the world look to cheap energy sources to jumpstart stalled growth. So, against this backdrop, the sustainable finance agenda really comes into focus. Despite growing concern about deglobalization, one effect of COVID-19 has been to demonstrate just how global climate and broader ESG issues truly are. There's nowhere to run, nowhere to hide. International coordination is both essential and unavoidable if we're to address these important issues. In this context, the central banks and the Network for Greening the Financial System, or NGFS, continues to push ahead with new initiatives, including on risk assessment, ESG disclosure, climate scenarios and stress testing, while traditional standard setters like the Basel Committee and IOSCO are becoming more active in sustainable finance as well. I would also point out that, perhaps encouraged by the COVID pandemic, future regulatory initiatives could encompass more emphasis on natural capital and biodiversity goals as well. But the main thing for global financial firms, for the financial sector, is that the policy and regulatory framework should be aligned across jurisdictions. Another point I wanted to make is that new strategies will be needed in the post-COVID landscape. The move to remote work, greater reliance on e-commerce, less travel, the ongoing emphasis on social distancing, all of this has meant a big drop in revenues across many industries and a growing risk of insolvencies and bankruptcies. New business strategies are needed, and we should be looking to build back better with more focus on ESG issues. Related to that, this pandemic has exposed debt vulnerabilities everywhere. We are starting this crisis with a massive overhang of global debt, which is now over 320% of global GDP. That's 40 percentage points higher than it was in 2007. 2020 has seen government debt build up at the fastest pace in over a decade. Governments have approved almost $11 trillion in fiscal stimulus to date, with another $5 trillion in the pipeline. So while this increased debt is necessary and required for an effective fiscal response to support economies at this time of need, it will also bring with it all of the vulnerabilities that debt typically does in terms of the buildup of debt vulnerabilities and risks ahead. And little of this fiscal stimulus is being done with reference to sustainable development goals. Indeed, this growing debt burden will constrain both public and private financing for environmental and social goals, with low-income and developing economies facing some of the biggest hurdles ahead. So I want to end on a more hopeful note with the need for a renewed focus on opportunities in sustainable finance. One very promising area is further development of green, SDG, and other sustainability-linked debt, so bonds and loans, debt instruments. While these markets are growing rapidly, they still represent only around 1% of total global debt markets. So plenty of scope to expand, and investor demand for these products is growing very rapidly. Scaling up markets and enhancing the plumbing of markets, so our market infrastructure and so on, agreement on common terminology for sustainable investments, sustainable benchmarks, derivatives markets, all of this will help scale up sustainable finance as well. And more broadly, and to end, now is the time that we should all focus on greening the post-COVID recovery and finding ways to support a more sustainable growth model. Thank you very much.
Thank you for the excellent remark. She already introduced the brief background of the participant of this session, so I will not repeat to save time. Next, Mr. Tim Adams, the president of IIF, and Professor Ann Kruger from Stanford University will address keynote speeches. Two eminent scholars are also unable to come, thus they will give us the keynote speech on video.
Greetings to all. My name is Sonia Gibbs. I'm Managing Director and Head of Sustainable Finance at the Institute of International Finance, or IIF, here in Washington, D.C. It's a great honor to be here with you today. It's also my very great pleasure to introduce to you today the President and CEO of the IIF, Timothy D. Adams, who will be addressing the following remarks to the 2020 Institute of Global Economics Hannah Bank International Conference, Economic Paradigm Shift in the Post-COVID-19 Era and the Future of Finance. And I'm sure, Tim, you'd agree that this is an incredibly timely topic.
It is indeed, and thank you, Sonia, for having me here today for the Institute of Global Economics. It's a timely time to be addressing these issues, and I'm just really ecstatic that I could be a part of this conversation today.
And we're very pleased to be here, even if we can only be here virtually. We're sorry we can't be with you in person. So, Tim, I just wanted to start off with a general question here. I mean, you have such a long and distinguished career in public service, and you served as U.S. Undersecretary for International Affairs during the George W. Bush administration. And from that vantage point, I mean, something people are clearly very worried about is the risk of deglobalization. And is this affecting the world's ability to respond effectively to and ultimately recover from this pandemic?
It's a great question, Sonia, and the short answer is yes. It's long and complicated, but we have seen this trend of deglobalization that's been in place now for several years. And it's really unfortunate because the architecture that was put in place after World War II that has kept the peace and contributed to prosperity for close to 80 years has truly been remarkable in terms of human history or modern economic history. And it's with great sadness that I see so many capitals, including here in Washington, a movement away from that global architecture and its many successes. So there is some concern. There's some specific concern, especially with respect to dealing with the pandemic. As you've seen, there's been some walking away or backtracking from support for the World Health Organization, as well as the criticism of other institutions. And, I can't remember a crisis, and I've been in Washington for 35 years, a crisis in which we didn't have, combined and coordinated leadership at the very top of the political spectrum. Whether it was the Asia financial crisis or whether it was back in the 70s when we had the Arab oil embargo and really the launching of the G5 or the G7, or the great financial crisis just 10 years ago, and the numerous summits that succeeded in the following days and months of that crisis, whether it was in London or Washington or Pittsburgh or Seoul. We saw the global community coming together to solve a global problem. And in this crisis, the leadership just hasn't been there, and the cooperative spirit just hasn't been there. And I think that's incredibly unfortunate.
Well, and it's incredibly timely that our friends at the Institute for Global Economics and Hana Bank are bringing people together on this occasion to discuss these issues. So, one of the things that we worry about a lot, keeps us up at night at the IIF here, is the massive accumulation of global debt over the past couple of decades. So are you concerned that the big fiscal response that's been necessary for COVID will exacerbate these problems? And is there any will in the political community to be more fiscally conservative going forward? Does debt matter anymore?
Yeah. A great question, Sonia. As you know, we're in the fourth great debt cycle in the post-war era, and you and your team do a remarkable job of covering debt analysis. Our debt monitor is widely distributed and recognized globally as one of the best indicators and insights into this debt accumulation that we've seen over the past 10 years. And as you pointed out and point out frequently, debt levels, whether it's at the sovereign or household or corporate level, have reached historic highs. This is all pre-crisis. And with the crisis, we're seeing a rapid acceleration in the accumulation of debt. Again, household, corporate, and sovereign levels to really levels we haven't seen since the post-war era. The UK will hit debt to GDP levels that they've not seen since the 1960s, the US since the 1940s. So we are levering up quickly and rapidly and broadly on top of what was already a huge debt surge. While I recognize the importance of responding to this crisis globally with massive fiscal firepower, we need to address this crisis. We need to ensure that we can support demand in terms of keeping the real economy going. At some point, we're going to have to address how do we pay off this debt. A lot of it is on balance sheets of central banks, but at some point, and it's not in the next year or two, but at some point we're going to have to address how we deal with this massive debt overhang and how we ultimately begin to wind it down, which will take decades.
Well, that really brings us right to the focus of this session today, which is on the financial sector. And so from that vantage point, debt's very important to the financial sector, obviously. How do you see the pandemic affecting the financial sector? Do you see growing risk of more delinquencies and non-performing loans? Fortunately, the reforms that were put in place in the aftermath of the great financial crisis, such as more capital. So, for example, the banks globally raised over $3 trillion worth of high-quality capital. We've had less leverage, more liquidity. We've been stress testing our systems. A whole host of changes that have been put in place make the financial sector much more vibrant. And in fact, we are now part of the solution rather than part of the problem. We're not amplifying. We're actually acting as a buffer for the crisis. So from that perspective, it's quite positive. And the points I make are widely recognized and widely echoed by financial authorities. But we will see huge changes in the industry. Already, when you have 90 or 95, or in some instances, close to 98% of your workforce working from home, there are huge operational challenges and risks in terms of resiliency and cyber resiliency, operational resiliency. How do you function from home? I don't think JP Morgan or any other major global entity ever thought they'd see that kind of operational profile. Two is, as you point out, we will see a rise, a fairly rapid rise in insolvencies across the board. And there may be whole sectors, whole industries, whether it's airlines or other forms of hospitality and leisure that will witness and experience permanent damage and will have to be addressed in terms of banks' balance sheets. So we're going to have to find ways to think about how banks deal with that over the long term. And then how do we deal with these crises? How do we use our capital buffers? How do we ensure we have sufficient liquidity? And then our market making operations, which were made much more constrained in terms of the crisis and the reforms.
how do we ensure that we have the resiliency in terms of our balance sheet so that we can respond to market making and market dynamics going forward?
Now, that's a really good point, and it does raise the question of how the regulatory community is responding during this pandemic. For example, with regard to banks' treatment of the assets that are being affected by these rising delinquencies and credit problems.
Well, indeed. Well, so a number of things have happened. Obviously, central banks have put their balance sheets behind the banks and are purchasing corporate debt off the secondary market or off the run commercial paper, asset-backed securities. So the Fed alone has 9 new facilities that is being deployed to backstop the financial sector. So in some ways, the public balance sheet is behind the private banking balance sheet, but still our balance sheets will face duress because of a rise in NPLs. And so that's something we need to bear watching. And we're just talking with one leading financial supervisor or regulator today who talked about maybe we've made the capital stack of our banks far too complex. The various TLAC and Tier 1 and Tier 2 and how we think about capital and the variety of buffers, maybe we need to simplify it. So regulators are starting to ask the questions, not only how do we respond to this crisis, but how do we do a look back once we're stable enough and ask ourselves, was the regulations put in place appropriate? Was it too complex? Was it too much or not enough? And how do we fix that going forward? How do we fine tune the regulatory structure once we're safely past this crisis?
No, indeed. I think many would agree with you on the complexity of the capital structure there. But so in this light and in this context with the regulatory response and the pandemic response, do we think that have banks been doing the right thing in terms of helping their clients, their employees, their shareholders through these very difficult times?
Well, absolutely. There is obviously the challenge of trying to maintain capital as well as return it to your shareholders. And we've seen that's been a bit of an issue in Europe and the US, where supervisors and regulators have said, at least in Europe, we prefer that you not pay out dividends, that you husband your resources, that you keep your capital levels sufficiently high and provision given the coming wave of NPLs. In the U.S., the banks have voluntarily given up on buybacks. There's been no official declaration in terms of dividends, and I don't suspect that will happen anytime soon. So it's managing and balancing the needs of your shareholders with also the needs of your employees. How do you take care of your employees when obviously 90% plus are working from home? How do you reboard them in a way that makes it safe and putting their health interests first and foremost? We have the same challenge at the IF as we just today actually reopening our offices. But I don't suspect that our employees will return until probably the fourth quarter at the earliest, simply because we want to make sure they're comfortable in the new environment. And I hear that from CEOs globally. And we have to rethink about what does office space look like? Do we need large office towers in Canary Wharf or in Midtown Manhattan? Might we be more distributed in the way in which we work and where our employees are located? So there's a whole host of different ways we've been thinking about it. And then just continued support for our communities. We're supporting the real economy, continuing to lend to our clients and our customers and to communities. I hear that from every CEO, continue to make sure that we have sufficient capital for the real economy. And bankers have been doing that. We have been providing capital wherever we can, often in times in concert with public authorities, depending on which country. But we have been active in supporting the real economy.
All really great points. And one other question that often arises in connection with the future of finance and future for the financial sector is one of consolidation. I mean, is COVID perhaps going to accelerate a process of consolidation, either in banking or asset management or elsewhere in the financial services industry?
Another great question, Sonia. I think we're going to see a number of trends that have been in place for some time accelerate. The digitization of finance, both in terms of the front end, the user experience, as well as the back end, taking costs out. And I think what we'll see with the huge technology spends that have been occurring previous to COVID-19, banks like Bank of America or JP Morgan or, Barclays, spending billions of dollars on technology, which makes it very difficult for small banks to do so. In the US, we have about 5,000 banks. We had about 10,000 banks 15 years ago. So we're seeing consolidation in the industry simply because you need scale and simply because of the amount of money one must spend in order to invest in the latest technology. And I think we're going to see in the asset management business, we've seen a real shift to passive management from active management. Margins are thinning out. And we're already seeing, such institutions such as BlackRock and others grow ever larger. They're certainly really good at what they do. But I would suspect we'll see other asset managers consolidate over time, just as margins are thinning and the nature of investment behavior by households continue to shift.
So you mentioned the U.S. Financial sector, and I wonder if you could share your perspectives, thinking of the long experience that you've had with the U.S. How do you see U.S. financial regulation evolving, either under a Trump or a Biden administration in November?
Yeah, sure. Well, we've had 3.5 years of experience under a Trump administration, so I would suspect that we continue to see a continuation of what's been in place. And I would refer to it so much as a light touch, but one of allowing the industry to evolve and focus more on supervision and less on regulation. There's been a tremendous amount of regulatory changes put in place over the last 10 years, almost to the point of exhaustion. So I think we have seen a shift in the U.S. towards more supervision, less regulation, and let's really understand what we put in place so that we can understand whether or not all that was needed and whether it's counterproductive. And again, back to the point where there are particular regulations put in place, so we make the system so complex that it made it more difficult to respond in terms of this crisis. Under a Biden administration, it's not clear. It really depends on who President Biden would put in key roles at the Federal Reserve or the FDIC or the Office of the Comptroller of Currency or even at the Treasury. If he goes with the traditional sort of Clinton-Obama administration officials, centrist, thoughtful Democrats, then I think you'll see a similar trend of what we've seen over the last few years. If he tacks more to the progressive wing of the Democratic Party, then it could be a much more challenging environment for banks going forward. I don't think that's going to happen, but I certainly can't discount that as a possible option for a Biden administration.
So for our last question here, why don't we switch to financial markets? And, just kind of looking ahead, do you think that financial assets are correctly pricing the shape of recovery? Maybe our stock market's getting too optimistic, or do credit markets accurately price the risks that could lie ahead of us?
The markets have been very buoyant, and in my mind, they're sort of priced to perfection. And it's no surprise when you've got the amount of quantitative easing that we've seen put in place in Asia and Europe and in the U.S. There's a tremendous wall of capital out there in search for yield, and it's really supporting prices and suppressing yields and spreads. Back in March, for example, Sonia, that we saw this historic outflow of capital from the emerging markets, from the frontier markets, and from many low-income countries. And now we're actually seeing a reversal of that just 2 months later, as investors sitting on close to $2 trillion of cash in the U.S. alone are looking to deploy that capital in a way where they can generate returns. And you can't generate returns off of buying U.S. treasuries or gilts or any other bonds or any other sovereign asset. So the search for yield and the effects of quantitative easing sending investors out the risk curve means that prices are pretty buoyant. And to me, it seems like it's front running the real economy. I think there's still real challenges. There is a recovery in the global economy, but I don't think the recovery is as robust or as progressed sufficient to warrant the prices that we're seeing.
Thank you, Tim. You've been very generous with your time, and I think we will hand over now to the rest of the session and give our thanks to the Institute for Global Economics and Hana Banks for having us here today.
Great. Thank you, Sonia. Thank you. It's been a lot of fun. I wish you all the best. All the best for a great conference. Thank you for allowing me to be here today.
Let me start. Thank you, Anne, very much for joining us at our conference. We are delighted to have you here. The first question that I would like to pose is about macroeconomic prospect, and how serious is this pandemic crisis compared to previous ones?
Well, thank you for inviting me. I'm pleased to be here and talking with you, but it would be nicer if we were in person. It's very hard to say how serious this is because it's so different from whatever's gone before. In other depressions or recessions, what has happened is that economic activity started decreasing, and then it accumulated and kept on decreasing. Here we had a very sudden and sharp stop. We had to stop because of the pandemic. Lots of people in lots of places lost their jobs very, very fast. Here in the United States, the numbers are unbelievable. But the question is, as we open up, will people believe that things are going to get better, or are they going to stay cautious? And will the opening up come too soon, in which case more people will get sick and we'll have a second wave? Unfortunately, in the United States right now, it looks like we're getting a lot of people sick because there was too much opening up too soon. And that's a problem because then everybody's going to be more scared the next time, and the opening up will be even less effective. I thought that if we kept the opening up for later, then when it happened, everybody would be confident enough and employment could pick up quite quickly. But as it is, it looks as if people that opened up, even factories, are closing again because of people having the coronavirus. So it's very difficult to forecast how it will be.
How about policy responses by major countries? Of course, they have been pursuing aggressive fiscal and monetary expansion policy. By and large, would you be happy with the way the country has responded to the crisis so far?
Well, I think the crisis had to have two parts to the response, one of which was to attack the virus and get it under control, because that's a fundamental issue. And unless that's done, nothing else is going to work for very long. So in effect, I would grade everybody, I think, on three things. One, how did they respond to the virus first off? Second, to what extent have they been able to manage that? And third would be the macro policy that goes with it. And in the United States, at least, most of us think that the epidemiologists were right, that we should have stayed in phase one, i.e. the lockdown, for a longer time. We let up too soon, and we're likely to be in trouble. And there are other problems, too, with the way we've responded to the coronavirus, which makes everything else worse. So, in effect, I would give the United States very poor grades in terms of initial response. Some other countries did very well, and as you know, South Korea is one of the ones that looks as to have done very, very well in all this, and has managed to get the contact tracing and those kinds of things going, which are hardly started in the U.S. at all. So there's very little of that, and that's a big problem. So there's all of that. A big question, of course, is how soon will we ever get a vaccine, because that will make a huge difference to everything once we do. Other countries are very different. Norway and Denmark seem to have done very well. Sweden very badly. Italy did very badly at first, but then corrected and seems to be now doing much better. The Germans seem to have done very well. And as you know, New Zealand has done very well. So some have handled the virus very well. On the macro side, I think, again, it differs by country. But on the whole, I think the macro response has been more satisfactory than the average response to the virus, where I think there have been lapses and opening up too soon or not being strict enough at first and that sort of thing.
Okay. All right. Thank you. Aside from dealing with the virus now and the risk of a second wave, what are the major threats that you see on the road to the recovery? Recently, I noticed that you raised your voice about the danger of high level of indebtedness of emerging market economies, and you emphasize the importance of a multilateral approach to this problem. Could you elaborate on this?
Well, I think first off that there's a huge difference among the emerging markets and developing countries. Some are much more able to handle their fiscal response because they've got some fiscal space, and others were already facing troubles before all this came along. So it's very different between countries. Some countries right now are okay. India, for example, I think is spending enough. The big problem, in fact, will be if they get the pandemic under control, then they'll have some problems fiscally, but they'll be from over-indebtedness then, not now. So that's an issue. But there's a second issue, too, which I think is equally important, and that is that many of the emerging markets and the developing countries, and especially the less developed countries, do not have their own medical supplies anywhere nearly as much as they need, and they are going to need help that way. And there I think they're going to need help in kind. I do not think that we can just say, okay, we'll lend you some more money, because they will just be bidding up the price of the scarce supplies, and there's going to have to be something done through the WHO or another mechanism to make sure that the poor countries have some ways of addressing the virus, because as long as it's there in the very poor countries, the rest of us won't be safe anyway.
And let's move on to issues more directly related to finance, international financial system and financial industries. What are the major changes that you expect in the so-called post-COVID era?
I need a crystal ball to answer that, I think. The obvious thing, of course, is that the shift to digital business to business will move a little bit faster. It's quite clear that there's been more success with people working at home than they expected. It's clear they won't stay there now. People will go back to their offices, but I think maybe the shift to digital will be faster than it would otherwise be, which is going to affect all of us in a whole variety of ways. That's certainly number one. The second thing, of course, is that I think there are going to have to be more precautionary reserves and savings on everybody's part, and that may be a macro issue as we go forward. If indeed people have saved more because they know it can happen, or something like it can happen again. So I think that's an issue too. But the third issue is on the other side, which also has implications for finance, and that is if, for example, we were to get a vaccine next, let's say January, and if that vaccine could then give people the confidence they need, we could have a very quick upswing where people who have not been spending as much as they would because they're locked up at home and all that, would all of a sudden try to spend, and we could all of a sudden, with all that macro, get an inflationary burst, in which case interest rates will go up. And so I think the precautionary the stances for, I think, the financial institutions will need to be take a broader look at the risks on both sides, because on the one hand, we might have things go badly and have a very prolonged recession. But on the other hand, there could be quite a quick upturn if we could get a vaccine, or if we get testing methods that are really effective.
By and large, what shape of a recovery do you anticipate? A lot of talks about V-shape, U-shape, W-shape, Nike logo style. What is your thought on this?
Well, I still think it depends on how the health sector goes. It's interesting, we always talk about business confidence. In this case, I think the issue is health confidence. If people are confident that they can get up and around and they can go and do things as they normally did, I think that we might have a very quick recovery once people get that confidence. On the other hand, the longer that we have a period where they start and go, we go into phase 2, as they call it here, then they go back to phase 1, then close things down again, and so on. The weaker the recovery will be, and the longer it will take. It's a very hard thing to say which way it will go. Now, what do I hope for? Well, of course, the first thing I hope for is a very rapid discovery of vaccines and very rapid ramping up the production. I mean, the vaccine would, of course, be a vaccine with long life that is very safe and indeed is 99.99% effective. Once we get that, we've got lots going for us. The second thing that we need for that is that countries get a lot better at the contact tracing and all that I get in testing, but I think you and Korea have done very well. People are counting on what Korea did as a model for the rest of the world. Unfortunately, so far, I don't think we've learned our lesson on that. And I'm afraid that we may have to have a second surge to do that. By the way, today was the highest number of cases reported on any single day yet. It's going up, not down, worldwide. So that's an unfortunate thing, even though in my state it's going down. The east coast of the U.S., the northeast coast of the U.S. is better, but the south and the west and the Midwest are doing worse. So that there's a different geography there. I think, though, that the more likely prognosis is that we're going to see some people do better than others, one step forward and a half a step back, others 2 steps forward and staying there a while. And so we're going to see a little bit, we're going to see a pickup, I think, from where we were at in March and April. And I think the May numbers are already showing that things picked up a bit, but whether they'll pick up enough to get some momentum on a recovery this quickly, I think is more doubtful. I fear the second surge will bring us back to more trouble.
As you know, international financial community is getting more worried about U.S.-China tension.
As it should.
How would you feel about this? How do you think this tension will evolve down the road?
Well, I hope, of course, that it will evolve by diminishing and getting back to some basis, a better basis of trust and an open system on both sides. I think there's a real problem right now that both sides have lost trust. Neither side trusts the other at all, and I worry about it a lot. In fact, I was worrying about it extremely before the pandemic, and at first I thought perhaps the pandemic would remind us that we are all human beings and that perhaps things would go better than they have. But unfortunately, that so far has not been the case. I do think that the Chinese did not behave as badly as the American administration has asserted in terms of their behavior with WTO. I think that in the sense the start of the trade war was a mistake, both because I think it was unwarranted and because I think, of course, it's negative, it's doing harm to both sides and no good. So basically, I would hope that we could come to some rapprochement. But at the moment, unfortunately, political leaders in both countries, I think, have been sufficiently, put off by what's happened so far, that the hope for getting back to a more amicable basis for our relationship isn't as great as I would like it to be. But certainly, I would hope that over the medium term, once the tension goes away from the pandemic, people could face up to the difficulties that are likely to confront us all if we cannot get the U.S.-China relationship sorted out much better than it is now.
Perhaps one last question before you go to bed. This is a late hour over there. Now, future of Hong Kong. You know, for those who working in the area of international finance, obviously this is an issue. How would you see this future shape of Hong Kong? Is it going to lose the international financial hub status down the road, or how do you see this with this Chinese hardline stance on Hong Kong lately?
Well, I think the stance is clearly unfortunate, and it's quite obvious that the citizens of Hong Kong are unhappy with it. So we could start there. Hong Kong, of course, has built up a very good financial services industry and has done very well with it. So in effect, as long as they can, I think people will stay there. But unfortunately, I fear that once the Chinese law has been enacted, I don't know whether it was today or not, but once they come in with their monitoring of things in Hong Kong, that if things go from bad to worse, then of course the various financial institutions will try and move their headquarters, I think. So I think Hong Kong is definitely at risk financially, but that will be because of the political risk, not the other way around.
Okay. Well, thank you very much, Anne, for your very insightful views shared with our audience today. Thank you very much for your time. And I look forward to seeing you in person rather than virtually.
I hope so, too. And thank you very much, and good luck to you with the conference.
Okay. All right. Bye now. Thank you.
Bye.
Okay, thank you for the excellent dialogue of President Tim Adams and the Professor Ann Kruger. Two speakers analyzed the effect of the corona on financial industries and the macroeconomy. They covered various issues, including the debt problem and the digitalization and the economic recession and the asset bubble problems, and finally U.S.-China economic friction issues. So we will move to the discussion sessions. So we invite three panelists, Dr. Michael Taylor, the Chief Credit Officer of the Moody's Investor Service, and Professor Shin-Seung Hwan, Professor of Hongik University, and President of Korea Money and Finance Association, and Mr. Kim Hyung-gon, partner of the Boston Consulting Groups. First, Dr. Michael Taylor will discuss. He is right now, he will attend the discussion online because he is now in Singapore. Discussion has about 10 minutes, okay?
Thank you very much, Professor Kim, for that introduction. And thank you also to IGE and Hana Bank for the kind invitation to speak at the conference today. It's a great shame that I'm not able to take part in person. It's always a pleasure to visit Seoul, and I would have loved to have had the opportunity to visit Seoul again. Unfortunately, because of the travel restrictions, I'm not able to attend on this occasion. And the fact that I'm taking part through this video link, I think is an indication of how the world has changed as a result of the coronavirus pandemic, and how that is changing the way that we live and work. And that is the subject. I have a very brief presentation, which I'd like to share with you. That's the subject of this presentation. It's based on a report that we at Moody's published last week, where we did something slightly unusual. Most of our research is focused on a relatively short time period ahead. So we generally look 12 to 18 months ahead in our research. But what we wanted to do on this occasion was to look at the impact that the coronavirus can have on the way that the economy functions, the way that we live and work, and what that means for credit over a longer period of time. And I'm just going to share my screen with you now so that I can just quickly take you through the presentation. So this is based on the report that we published last week. We called it Credit After COVID because the whole intention is to focus on how recent developments are going to change the way that we look at credit and how credit impacts our lives. And we see this as being a crisis of historic proportions. It is going to result in fundamental shifts in the way that economies, societies, companies operate. And what we wanted to do is to think about what would the new normal look like. And I think some of the topics that we've identified are the ones that have already been talked about today. And so I'm not going to go into those in a lot of detail. But what we decided was that there were 6 major trends that we saw as being important from the point of view of credit in the post-COVID world. And those trends, in each case, it's nothing that's new. In each case, it's an acceleration of a trend which is already happening. And those 6 trends are that we expect long-term growth to weaken across many major economies. In effect, the coronavirus crisis is going to inflict lasting damage on the economies of many major economies in the world, and that it will leave some permanent scars on those economies, and that will mean weaker growth in the longer term. Secondly, partly as a result of that, we expect interest rates to stay lower for longer, and indeed for longer than we had previously anticipated. We're expecting that global trade will become more fragmented, that there will be some de-globalization taking place, as we heard from Tim Adams earlier, and that as a result, we will see, again, some decline in terms of the long-term growth potential across a number of major economies. Consumer habits, we think, will change permanently, and that will lead to accelerated disruption as a result of adoptions of new technology. And that will have different credit effects across different sectors. Some sectors will obviously be quite affected and negatively by that. Other sectors will see some positive gains out of this tech disruption. As we've also heard in the other presentations, we think that governments are going to have to take on new social mandates in response to increased concern with the availability of healthcare, in terms of greater concern with social inequality, and that will feed through to the way that governments function in society. And also, as we're seeing as part of the support packages, that governments are taking ownership stakes in major companies, such as airlines. And that will also change the way that governments have operated for the past 30 years. And then finally, we think that, and as again, I think Sonia Gibbs emphasized this in her presentation, we think that environmental, social, and governance issues, ESG issues, are going to come into greater focus for investors, and their credit relevance is going to rise. Now, I'm not going to go into all of these issues in a lot of detail because obviously we're quite short of time. So let me just pick out a few which I think are most relevant, particularly from the point of view of the financial sector, which is the sector that we're discussing in this panel. In terms of the weakening of long-term growth, that will obviously have some negative effects for the financial sector. From the point of view of governments, we're expecting to see higher fiscal deficits over a fairly long period of time. Deleveraging, both in the public and private sectors, will be delayed. We'll see slower corporate profit growth. All of those factors will have negative effects for the financial industry. And indeed, financial industry profitability is going to be negatively affected by the second major trend, which is that interest rates are going to stay lower for longer and longer. So what happens as a result of that is that we'll see a looser credit environment, greater availability of credit, more liquidity. We'll see highly leveraged companies able to cover their interest payments more easily as interest rates stay low. So we'll see improved interest coverage, but leverage across the whole economy and across many sectors is going to be higher. And a third implication is that we'll see more zombie companies. That is to say, companies which cannot cover their interest payments from their current cash flow. And the restructuring of those unviable companies is going to be delayed by these lower for longer interest rates. That will have macroeconomic impacts in terms of a slower rate of economic growth, productivity impacts in terms of the economies becoming less efficient, but also it will have implications for financial companies too, because again, for banks, the credit soundness of their borrowers may well be lower. We may see at the same time higher potential default risks in the event that there is another economic downturn in future, given these poorly performing, highly leveraged companies. While at the same time, we'll see asset price inflation as a result of these lower for longer interest rates. So all of these factors will have negative effects from the point of view of the financial industry's credit quality. I'm not going to go into detail in terms of global trade because that has probably less direct effects for the financial industry. But let me move instead to talk about what changes in consumer habits will mean in terms of financial industries as well. And there, the big impact is in terms of tech disruption. Again, in line with what I said about the way in which the coronavirus crisis is accelerating existing trends, then we expect to see it leading to a greater embrace of fintech. We've already seen the much broader adoption of contactless payments, for example. Although I think in this part of the world, in Asia, that's been much less of a change because we've had contactless payments in this part of the world for a long time. But certainly in Europe and North America, it has greatly accelerated the move towards contactless payments. So we'll see more services moving online. We'll see a greater role for fintechs. And that will be positive for the fintechs themselves, for IT companies, for artificial intelligence. And the real losers in this process, not just in the financial sector, but I think in the corporate sector more generally, are bricks and mortar retail, areas like public transportation, traditional media, and entertainment. Moving on to the last two issues that we identified. First of all, governments, we think, will have new social mandates. Social safety nets will need to be strengthened. This will be a demand of populations, voters in many countries as a result of this coronavirus outbreak. That will mean changes in terms of spending and revenue priorities. It may also lead to an increase in support for national champions. I talked earlier about governments taking equity stakes in companies. So we'll see, I think, greater promotion of national champions. And certain sectors will attract greater regulation, perhaps not so much in terms of the financial sector, as long as we avoid a major problem in that sector. And as again, Tim Adams has explained, regulation over the last 10 years has strengthened quite considerably around the financial sector. But there are other sectors which may become more highly regulated as a result. And I think particularly here, it's the role of big data and the increased recognition of the importance of big data will start to result in higher levels of regulation of companies which have access to large amounts of data. And then finally, ESG, we think will come into greater focus. Again, it's an acceleration of an existing trend. But I think, again, from the point of view of the financial sector, one factor which could again have implications is this last point in here about the shift towards a multi-stakeholder approach to corporate strategy. So less emphasis on shareholder value as being the chief objective of management, and a greater recognition that there are other stakeholders whose interests also need to be balanced. And that will change the way that companies, particularly financial companies and other companies, will operate. We'll see more emphasis, I think, on things like risk management practices, a greater preparedness or a greater attempt to prepare for large unexpected shocks, building more resilient systems, building a greater ability to respond to these high impact global events. So that, in summary, is how we see the impact of the post-COVID world. It's going to be a world with lower growth, lower interest rates, greater challenges across many dimensions for companies and for financial sector companies. And it will be one in which we will see some erosion of credit quality over time. So with that, let me hand back to Professor Kim, and thank you.
Okay, thank you, Dr. Michael Taylor. He covers various issues, including the macroeconomic perspectives and debt value issues and the digitalization and the role of government and ESG. He covers these kinds of issues, and that was the excellent comment on these issues. Next, Professor Shin You got about 10 minutes, okay?
Less than 10 minutes. First of all, my apologies for not preparing a visual aid, but my points are quite simple, so I think you have no problem getting my points. I'll give my views on two things. The first, the big picture of financial services industry and financial companies after the corona the situation. And second, on the role of finance authority in case of Korea, FSC and FSS, to accommodate the development of financial services industry. First, on financial services industries and financial companies. I guess all of us would agree that the coronavirus expedited the fourth industrial revolution, so-called. Look at the price-earnings ratio of Amazon. It is 120, whereas the PER per of KB Holdings company, the finance group in Korea, is just 5. Looking at these numbers, I realize that I belong to old generation now because I really don't understand what's going on there. Living through this corona crisis, many people actually experienced various kinds of online services, and I believe they feel more comfortable with online services now than before. Then the question is, what does it mean for financial industry and for financial companies? For financial companies, I guess it will mean emergence of more platform-based online financial services. It will mean more new entrants into the financial industry. As financial services are more platform-based, the incumbent financial companies are at risk of being subordinated to this platform provider. And we all know that in finance industry, whoever has the customer network takes the bigger share of the margin. And even within the company, whoever has the customer network has the highest chance of going up the corporate ladder. Therefore, I think the incumbent financial companies should transform their organization and culture into a lean and agile organization so that they can collaborate with platform companies or even become a platform company for their own. Second, on the role of finance authority. The another thing that I'd like to mention is about the role of financial authority. As I mentioned, most people agree that coronavirus expedited the transformation of financial industry. In fact, it is so fast and multi-dimensional that financial authority can hardly predict the direction and the lead transformation with promotional industry policies. Under the after-corona circumstance, I would like to suggest that the finance authority put 100% of their efforts in regulation and supervision for financial market stability and consumer protection, or for consumer benefit in a more fair term. Of course, too little regulation is as bad as too much regulation in financial industries. Developing right regulations in line with industry development is itself a tremendously difficult job to do. Tight supervision without imposing too much burden on financial companies is also a very challenging task. The role of financial authority in financial industry cannot be overemphasized. I hope that our financial authority worry about regulation for consumer benefit and financial market stability rather than our economic growth that is actually worried by many other parts of the government. Thank you very much.
Thank you, Professor Shin. The next discussant is Mr. Hyung-Moon Kim, the partner of the Boston Consulting Council.
Okay. Firstly, thank you for inviting me to this meaningful conference. We'll cover shortly about some our perspectives on retail business and B2C business in the financial sector for the next 6-7 minutes. We all know that recent crisis of COVID-19 will heavily influence the financial sector without doubt. Especially the fundamental change of the sector will be accelerated by the change of customers' needs and behaviors. So first and foremost, we should address this dramatic change of attitude towards contactless interactions, or as it is called in Korean, untact phenomena. A number of customers who prefer traditional offline channels have been changing their purchase patterns by shifting to online channels, not only for purchasing food, clothes, but also for the financial products and even cars. BCG survey on US financial institutional customers show that more than 20% of respondents started using digital banking after COVID-19 for the first time in their life. And 80% of them were very satisfied with that digital experience. And 24% said that they will never go to the branches even after the COVID-19. Moreover, on overall utilization of personal media and internet, such as YouTube, Naver, would take a quantum jump since customers are inevitably spending far more time at home than ever before. And as time-killing behavior with media and internet increases, naturally people will be more influenced by the information gathered from these kind of sources. And eventually, this certain pattern of information gathering would be regarded as an effective way for self-learning and self-education on personal interest, even regarding financial investments or financial products. And you can see a lot of contents in the YouTube saying a detailed strategy on ETN, ETF, investment, or individual stocks, and they are very interesting and very interactive and with fun. So it's very different than conventional financial institutions' contents at all. And especially millennials and next generations, who are the future core customers for the most financial institutions, are heavily exposed to these kind of knowledgeable individual influencers in the digital world. And they are becoming powerful brands themselves. And this is a kind of freaky phenomenon, I think. So consequently, self-guided investments are going to be a quantum jump through the digital platforms like KakaoBank, AIM, or TOS. Automatically, loan products or passive active funds from incumbent financial institutions, I think is going to be likely to be growing very in a minimum level. On the flip side, however, I would like to emphasize these changes customers' behavior can generate a very new opportunity to traditional financial institutions in terms of go-to-market. Typical approach is inbound and wait-and-see approach, but if you can acquire many information out of this kind of digital touch points and understand customers, and if you can reach out these customers throughout these kind of touch points, then you will have a great opportunity to do some customized outbound sales, and that is, I think, a very good opportunity. At the same time, I think we should be really think about building up brand excitement on our conventional financial industry's brand. We are competing against, as Mr. Shin said, fighting against Naver, Kakao, or even game companies who are to be jumping into this financial domain. And these guys are, as I said, with fun and has a very credible brand to the millennials and next generations. And we should be fighting against these guys, and that's saying you need a totally different brand strategy than before. So I would like to shorten my speech with three things as my suggestions. Firstly, it is very essential to secure and invest enough resources ahead for winning this kind of confusing convergence war by expanding our ecosystem, not within the financial domain, but to the non-financial domain as well, because as you see, we are fighting against not just the financial institutions, but life occasion-related players. So we have to be really, I think jumping into that kind of domains in a very active way. Secondly, we really need to create that brand excitement and fan for our brand. Kakao has a more credibility or reliability than KB or Hana brand, if you can ask to the juniors or millennials around your environment. So we have to be rethinking all the strategy on brand. And lastly, as Mr. Shin also said, I'd like to emphasize that we need entirely new talent, new governance, new organizational structure really to be jumping into this new disruption. Okay, thank you.
Thank you, Mr. Kim. We expect the corona pandemic will change the financial environment. Digitalization and untapped practice will change many things. It could reduce the employment and increase the government interventions or the financial supervision for the security problems. We have many issues, however, we have very limited time, so we didn't discuss all the issues. But this session, I hope, will help the financial service industries. It's time to close our session. Thanks for the excellent presentation and discussions. Thank you very much.
Thank you to our moderator, keynote speakers, and our panelists. At this time, we will have a short break of about 15 minutes, and we will reconvene for our fourth session at 3 p.m. sharp. Thank you again.